Hello everyone. Today we look at what the concept of market cycles means. The market cycle is a broad concept that refers to trends in different markets. Basically, it covers a period within which the market shows similar patterns. It is such a broad concept that it does not give a globally interpretable picture at all. This also means that the length of a cycle varies from industry to industry, and that even when viewed at the same time, geographical areas may look different. The topic is much deeper than what a single video can cover, as no two market cycles are alike. Although the principles appear everywhere, but you will experience differences. That is why we are looking at its general structure today. Of course, since we are talking about a cycle, there is an increase and a decrease. You will see that when we talk about the growth phase, it does not necessarily go hand in hand with the growth of all investment devices. The whole cycle can be divided into 6 well-separable sections. Of course, you can also divide these into further parts, but today we looked at these 6 parts. The first stage begins after reaching the low point, then hope will appear. People start shopping, thinking the worst is over. This is also the beginning of the expansion. Production declined during the recession, so less raw material was needed. As for the low demand, the price goes down. So at this stage the price of raw materials is down compared to the other stages. It is easy to buy from it so that the stimulating demand can be served from it. There will also be financial coverage for this, at least for those who survive the recession. Governments and central banks will then focus on stimulating the economy. The most common sign of this is that the central bank has cut interest rates. The low central bank base rate is helping the recovery from several directions. The first is that because banks also charge their own interest rates according to the base rate, the low base rate also makes commercial loans cheaper. This allows companies to say yes to more investments. The low interest burden also reduces the risk for banks, so they also prefer to give. However, there are examples of companies needing more money compared to this so much more, that they can no longer get through banks, then bonds are issued. What you can see in the economy is that the price of raw materials is permanently down. Investors are interested in what they get for their money, and at low base rates they don't get much interest on government securities. Many people do not trust stocks yet, so there is a growing demand for bonds that are newly issued or are already on the market. GDP and other economic indicators are starting to improve as the credit boom drives more money into the economy. People spend more, sales and productivity also increase. This in turn has a beneficial effect on the performance of companies, thereby also driving up the price of shares. With what you can achieve results in this case, for example consumer sector shares. After all, people are happy to spend feeling the breeze of the upcoming boom, but you can get just as good with a sector that serves the luxury goods market. There was either no money during the crisis, or even if there was money, purchases were postponed as a precaution. You can also achieve good results with the help of the technology sector and the industrial and financial sector, as businesses and their consumers also need credit. In addition to stocks, you can do well with bonds, but the time for commodity exchanges isn't came yet. The second stage begins when the influx of new capital and growing opportunities fill people with optimism. Prices are rising, investors are looking for new opportunities. As the economy continues to grow, there is no need for further economic recovery from central banks and governments, so the rise in base rates can begin. Raising interest rates is also important for maintaining the purchasing power of money, as rising prices are legally accompanied by a rise in inflation. One of the main tasks of central banks is to keep inflation on a certain level. This increase in interest rate will reduce growth in interest-sensitive sectors. These are typically those sectors that require significant investment, those who producing something. However, the information and technology sector is not included. They do not need large buildings or other high-value investment to operate. At this stage, growth continues. Lending continues to grow, along with sales. Towards the end of the phase, the rate of growth is already declining. On the one hand, the person who bought now uses the product, does not necessarily buy another, and on the other hand, the loan also has a cost. Thus, productivity and profits are slowly peaking. What you see in the economy is that stocks are doing just fine overall. Although bonds are already outperformed by equities, there is even a demand for them. Unlike before, you'll see that a lot of raw materials are already being used at this stage, so their prices are starting to go up as well. At this stage, the stock market is performing well as investments based on it. Bonds are already best recommended for lower risk levels and shorter time horizons. In the third phase, the slowdown is already beginning, but it is not a decline yet, only a slower increase. You will notice this from the following signs. Since many people have already taken the opportunity to shop, obviously fewer will buy. This is why industrial productivity and profits are declining. The loans will be dispersed on stricter terms, which in itself is sufficient to strengthen the previous point. As a whole, GDP growth is slower. In the economy, you can see that the price of raw materials continues to rise along with the price of stocks. As borrowing has become more expensive and the price of raw materials has also risen, there is less chance of profit on stocks, but still there is. You can't say the same about bonds, the demand for them is expected to decline here. This is due to several things. The first reason is that the outlook for stock returns is higher than for bonds. The other is the interest rate increase already mentioned, which also affects the interest rate on newly issued bonds and due to factors known about the duration, also affects the demand for bonds already in circulation. Where can you invest then? Unlike the previous phase, here it is worth taking a close look. There is still a demand for raw materials, but if you go in that direction, take a close look at who the buyers are. After all, if for a sector is no longer worth financing growth anymore, it won't need raw materials as much. Although the performance of stocks is still positive, as sales and productivity decline, the price of their shares will no longer soar. You can only make a profit like the previous one at a higher risk or with more thorough work. Overall, they still outperform bonds. Thus, for investors who want to make more profit on their money than they can on the bond market, it can still be an attractive alternative. This stage is still in the growth phase, so it gives you a good opportunity to choose one or more index tracking funds for yourself, especially if that fund follows a stock index. Although if you want to keep security in mind, not just profit, a bond can still be a good form of investment for you. In the next section, you can observe the peaking. Sales are no longer growing, profits are declining due to rising costs. In the economy, you can see that the price of raw materials is still rising due to past, even contracted demand for them. This rising raw material price further reduces the chances of profit for companies, which is why capital is starting to look for another way that is more profitable or simply focused on security. As demand for equities declines, this will be reflected in their prices as well. Demand for bonds was already lower in the previous phase. Don't be fooled if someone offers you a bond at a high interest rate. This is not necessarily a sign that the company has huge growth potential. You may be dealing with a junk bond for a company that is no longer funded anywhere else. Now, in your investment basket, add tools that will be your safety in the event of a downturn. This can be done at having a lower level of risk, but you can also choose an instrument whose price moves against these economic events. If you understand investing or have someone to help you, these are the tools that have a negative beta. Stage 5 is already a stage of recession. Then GDP will fall, creditworthiness will deteriorate, and access to credit will shrink. Sales are also declining, productivity and profits are also declining as well. In the economy at this point, you generally see the price of everything falling. The declining demand for equities has already started in the previous phase, and this is already stronger in their prices. Due to more difficult borrowing and rising base rates, there was no longer any demand for bonds. As the companies do not produce as much, so they do not need raw materials, which is why prices are falling here as well. Then the defensive sector can perform well at this stage, although there is demand for the sector at any stage anyway. Examples are healthcare, the utilities sector, or companies that deal in basic consumer goods. Apart from the crisis, people still have to eat and go to the toilet. In other respects, during a recession, the performance of stocks and commodities used as raw materials declines. If you do not want to invest in stocks, a properly selected bond can also be considered safe at this stage. By proper selection, I mean primarily the credit rating of the issuer and the conditions under which the bond was issued. The bond is a debt, the interest must be paid in any case. During this period, you are better off with fixed-rate bonds than with inflation-linked interest rates. In a time of recession, what can still do well is any form of investment that typically moves in exactly the opposite direction to equities. That is, one whose beta is negative. This will be the opposite of the market. Gold is typically an example of this. Its price relative to the shares has either fallen or at least not risen as long as demand for the shares has been strong. At this stage, as well as if you stepped in on time, the previous one, gold may be an escape route for you. It's used to store value, so as long as the dark clouds dissipate, you can direct some of your money here from stocks. The sixth stage is still part of the recession, in which case, depending on the form of the crisis, the problems will deepen and more people will feel or may feel the approaching spring. The hardest part during this period is that no one knows how long it will take to see if there will be another setback. The only thing you can know is that it won't last forever. In terms of economic processes, you can see that low demand for commodities and stocks is pushing down prices, or fortunately the market is just sidestepping. For you, both of them mean it's a buying rate for your long-term decisions, and if you want to get results with them in the short term, well, that's not the time yet. What you can invest in such a case depends on for how long you think about investing and how much capital you have. Looking to the long term, at the end of this stage approaching the next stage, you can even think in terms of stocks. In short term, you can move around the bond market the most. Gold may not be a good solution at this time. After all, it has grown significantly so far. The question may rightly arise in you that there was a lot of talk about it, but not about the real estate. Real estate works like stocks, only with a much higher capital requirement in general. Another difference is that the sale, but in fact the whole real estate market is much slower. That's why with a time lag, but the stocks will be followed. When people have money, it will be directed not only into stocks but also into other forms of investment. If they need a loan for this, they will take it out when borrowing is relatively easy and cheap compared to the other stages. But it takes time to go through this, find the right property, or just build it. The same is true before or just during a recession. The peaking phase will not happen everywhere at once. Notice that the price increase may have stopped in a big city, but properties that already measured price of gold in the agglomeration is still changing hands for higher and higher prices. But even in the event of a recession, the buildings that have already begun must be completed, and must be sold or rented, otherwise the loss is guaranteed. What can you see from this on your own? You can achieve higher results on different investment vehicles at different times. Two things already follow from this. One is that there is no perfect form of investment. It is not enough to have a single type of device, and it will serve you no matter what the market situation is. In one stage of the market cycle, one asset will be more profitable for you, in the other stage something else will be good, while in the first stages investment will either hang or fall sharply. From this follows the other thing you can already see. You need to put together your own investment basket, so that the assets in it best serve you. At this point, I would like to draw your attention to two things. On the one hand, diversification. While it sounds good to have chosen that particular sector, divide your money in multiple directions. The other thing that matters is the concept of correlation. This shows the co-movement of the price of two or more investments. If you've chosen tools that move in the same direction for the same market effect, say they moving upward, don't be surprised if they move down together as well. You can mitigate your own risk by either choosing neutral instruments or buying ones that move in exactly the opposite direction. Why is it important for you to know these? On the one hand, to achieve greater profits. Although no one can ever tell you exactly when a stage starts or just ends, if you know how to achieve higher results in a given market, you will be able to move in that direction. This knowledge is also important to avoid loss. Many small investors have suffered losses because they panicked after the fall. Although I have drawn a nice regular arc in the video so far, this was only for the sake of clarity. If you know how market cycles work, it will be much easier for you. In real life, a setback can be a long-term downhill and it can look that way. Or it can be just as sudden a fall like this. Note that I didn't say it would be easy because that's not necessarily true. Even in the middle of a long tunnel, it's hard to imagine light coming soon, and many on the roller coaster screaming downhill as well. If you know this is just the beginning of another round, you can approach things more calmly. This will save you a considerable amount of money. If you want to build capital, patience is important to give time to money, but foresight is just as important. Remember that Rome was not built in a single day, but a few hours was enough to destroy Nagasaki.